been a lot of talk lately that India's potential growth rate has sort of slowed down. And this comes from the understanding that the current slowdown is a structural slowdown, and this has connotations for the sort of glide path to $5 trillion economy. So let's get your views on each of your views on exactly what is the potential growth rate, and if at all it has fundamentally altered over the last 4-5 quarters, as claimed by many, including some in the Central Bank of India, by which I mean RBI.
Sure. So I guess my view over here is that potential growth is a very hypothetical construct. It itself gets influenced by where your actual growth in the economy is. So on one hand, you can think of potential growth in terms of what is the supply capacity in the economy, and if you are delivering structural reforms, such as GST, removing interstate barriers to trade, delivering sort of bringing in the insolvency and bankruptcy code, which allows you to take out unproductive assets and put them in productive hands or change promoter hands so that they can start yielding more efficiency and more productivity, then these kind of reforms and efforts do improve potential growth, but it takes a few years of time. As Professor Arvind Nirmani had mentioned, there's a J-curve effect that takes time to allow potential growth to improve over a period of time. What has happened recently is that actual growth has dipped so sharply that people's estimates of potential growth are now being influenced more by where current growth is, rather than by how these structural reforms have boosted the potential for India's economy to grow at a much faster pace. So the way I see things panning out going ahead is that as soon as you start seeing a cyclical recovery, the reforms which are already in place, which allow for the Indian economy to grow at a much higher pace, the combination of the two will allow a non-inflationary increase in actual growth. And that would be the key highlight or the key benefit of these structural reforms that we will be able to benefit from. Since I have less time, I just want to touch upon a few things in terms of what could help India come out of this cyclical downturn. And one of the key questions is, what is the right fiscal monetary policy mix that we need to have? Because you hear arguments on both sides that sometimes people say that there isn't any fiscal space, because if you start with an expansionary fiscal policy, the government will have to borrow more in the market, and that is going to further increase bond yields and have a countervailing effect on any expansionary monetary policy. So my view is that the two need to go hand in hand. On one hand, the government needs to give some fiscal impetus to the economy. So the government should not be constrained by the FRBM target of having to reach 3% fiscal deficit target by 2021. I think the government is already thinking in terms of extending that by a year or two, and that would be the right thing to do. So you have a fiscally expansionary policy, but if you're going to have a fiscally expansionary policy, for that to have any positive impact on the economy, it is equally necessary to also have expansionary monetary policy, or to reduce interest rates simultaneously. Because if you don't do that, then you will have a fiscal policy which would then be crowding out private investment by increasing interest rates. So you need to have a combination of both fiscal easing and monetary easing, because the output gap has turned so wide that you certainly need a lot of policy support to bring India out of this cyclical downturn. Other than this, the other things that I'd like to see in the budget would be to address more measures to address the rising risk premia, or the financial sector uncertainty, more specifically within the shadow banking sector. Along that front, the government has taken some initial steps. It has extended its partial credit guarantee scheme. I think more on those lines, if that could be extended further into some sort of troubled assets program, which was unveiled by the US at the height of the subprime mortgage crisis. Something along those lines would certainly be beneficial to the financial sector, because we know that this is one of the reasons why consumption And investment within the small and medium industries has suffered the most because it was these NBFCs which provided the last mile connectivity for both consumption and investment by the small and medium enterprises. That's one thing. The other thing which I've already mentioned is it would be good to have some sort of mention of a review of the monetary policy framework. One thing to alter over there would be to target average inflation rather than have inflation as a ceiling, as I just mentioned. The other thing would be to not completely throw out an important data point which was a cornerstone of India's monetary policy making up until recently. Wholesale price inflation has a lot of valuable information in it. And if the government could think, or the central bank could think in terms of taking some sort of a combination of manufacturing inflation and core CPI inflation and targeting a measure which combines, which gives equal weightage to both or some sort of a weighted average of the two, and that is what the GDP deflator does also do. Because at the end of the day, you cannot just completely ignore the manufacturers or the industry side and only focus towards the real interest rates or the interest rates that facing the consumers. You have to be more balanced in your approach and look at what are the interest rates facing the industry as well. You cannot be completely ignorant towards that aspect of the economy. And especially we know that central banking is an important channel to sort of boost investment. So wholesale price index, wholesale price inflation needs to be considered into monetary policy. It needs to be brought back into monetary policy making. So that's the other recommendation. And besides that, I think there are measures which are already being discussed in terms of boosting consumption, whereby you could put more money in people's pockets. The two measures which I have heard are being discussed are, number one, personal income tax cuts, and secondly, allowing a greater pay for organized sector, the investment,
EPFO,
the PPF and stuff like that. I think that would be a great thing to do as well at this stage. And maybe after a few years, maybe after 1 or 2 years, you could once again revise that. But in the interim, that would be a good boost for the consumption sector, for household consumption to improve, because disposable income will increase quite sharply as a result of that. I guess those would be the three areas you need to address. On the supply side, address the financial sector shock so that credit can flow more freely. On the fiscal monetary policy side, you need to have a coordinated fiscal and monetary policy approach to reviving the economy, and you need to do something more on the consumption side.
I think that's very well put. I mean, unfortunately, it's your flight time, so you would probably have to leave. But we would, if anyone has any questions, I think if you don't mind, so we can have 1 or 2 questions before, just one question we can have before he has to sort of. Yeah, rest of them will be here. So, yeah.
Hi, this is Chetan. I'm from Python Services. Just a quick question to all of you, whoever could answer this question. We're talking more from the Indian point of economy, downtown and all that, right? So what's happening? I mean, I just want to know the view. What do you guys feel the view of the global economic down, which we are facing right now? Say, for example, how we can implement this in the coming budget. So, for example, we have a trade war happening from China and the US, and also from the viewpoint from what's happening in the UK and the Brexit, right? And also what we are moving towards the green energy, which is more from a renewable. I think one of the panelists talked about, moving towards the non-crude oil kind of a thing. And how do we take this as an advantage and, see it from the advantage from the Indian context? Thank you.
So I'll take the first part of that question and leave the green energy part to you, Harsh. I guess it's kind of encouraging to see that the government is noticing that there is an opportunity due to the ongoing trade wars between US and China. And in fact, a lot of firms had started moving out of China even prior to this trade war because of the rising labor costs in China. And so far, India had not really benefited, had been a beneficiary of that exodus of firms moving out of China due to rising costs. Other Asian economies such as Vietnam, Bangladesh, Philippines, these were the economies which have largely garnered that shift of investment base. But it's very encouraging that the government has finally taken notice and is taking steps so that it could also encourage FDI and take advantage of this changing landscape and put India into the global supply chain. For instance, reducing the corporate tax cuts was certainly a step in that direction. And the hope is that the industrial the industrial wage bill, which has now been, I think, referred to the standing committee, that has an important provision which essentially allows the government to change or impart more flexibility to the biggest concern which people have with labor laws, which is flexibility in terms of retrenchment or firing workers. So a provision in that allows the government to change that by an executive order, that the number, so currently if a manufacturing firm has over 100 workers, they need state permission. And the new bill now has a provision that the government can, by an executive order, change that number of 100 workers over which the state permission will be required. So if that goes through, I think that would be a really, really positive step in kind of allowing manufacturing boost together with lower corporate tax cuts.
So, you know, on the question regarding global slowdown, I don't know what in general other people feel, but my view of lately has been that there was indeed a slowdown in 2019, but the biggest reason that, you know, or biggest cause that has been identified is global uncertainty. And the reason of the uncertainty was, of course, the trade war and whether Brexit will happen or not. But in December itself, two developments have significantly reduced that uncertainty, because phase one of US-China deal has happened. And you know, the UK election outcomes with conservatives coming with a full majority, we now know that Brexit will happen with a deal. So that means that perhaps, you know, the global outlook for the next financial year may not be as bad as many were thinking. But what does that really mean for India, which was looking to benefit from the trade war in terms of influx of companies? I mean, of course, we are competitive now compared to other countries in terms of taxation, etc. But I mean, have we sort of missed the bus on that missing middle sort of kind of transformation that we were looking for?
Okay, sure. Yeah, no, I agree. From a very short-term point of view, it seems like the worst global news is behind us from literally a quarterist point of view. More long-term structurally, obviously, global growth has been slower, I think largely because of Western demographics. Then there is this thesis of global productivity not being as fast as it was, you know, during World War II and a few decades after that. That basically there is some kind of secular stagnation, is the phrase Martin Wolf and Larry Summers uses. So a lot of this is basically, you know, data massaging and retrospectively kind of fitting a thesis based on what happened. My personal sense is the pessimism around the global economy is overdone. I think technology-based productivity would once again come to the rescue in the coming decade. What it means for India, and specifically with respect to the US-China trade war, the US-China trade war is more geopolitical than it's economic. You know, the US does not want the Chinese economy to overtake it in GDP terms as soon as it was on a trend to overtake it. They want to delay that as much as possible. And the US simply is now turning back on that liberal international trading system because it no longer serves its purpose. And it has all kinds of ramifications. Now India is not joined RCEP, this Brexit is happening. So the high noon of global trade in at least goods, I would not come to services, may be behind us. The corporate tax cut, I think, was obviously useful. I don't think we've missed the bus in any significant way. I think even if technology makes automation and non-labor intensive manufacturing very productive, we are still about a decade away from that being a reality. So I do think there is a lot of scope for India to catch up even now in good old manufacturing. And there are other factors. If China, for example, is tramping down on pollution for its own, for the quality of life of its citizens, for tourism, etc., a lot of industries have therefore are on the margin migrating to India, like chemicals, petrochemicals, all kinds of intermediate manufacturing. So I think once these macro issues of credit, real rates of interest as far as the final business is concerned are taken care of, actually even Indian manufacturing may finally have its moment under the sun. Not joining RCEP, I think, was very, very critical to avoid a situation where that would not have happened.
Yeah, you know, this with respect to this particular moment, I always find it a little puzzling and in some sense worrying that we're trying to find ourselves in the interstices of some other value chain, right? I mean, no country which has succeeded was really trying to just absorb only a little bit. They were really trying to do a complete industrial transformation. So I completely buy the need for industrial policy. We've not done it well historically, and that's something that we have to really study. I'd add that another thing that we have to be cognizant of is what I refer to as the sociology. I mean, I think anyone here will recognize that somehow we have not got the productive labor force that we want that could easily plug in. You know, and that is the question, not just for exports, but across our industries. How are we going to develop this productive labor force, which is as flexible, as open, as productive as anywhere else? And I think that's a challenge that we don't really have an answer to, but that's sort of, you know.
I'll just quickly add one point there. Abhishek had mentioned, he's left now, that, you know, from a short-term demand perspective, maybe lowering the PF contribution of the employees would be beneficial. Another additional benefit of that would be further formalization of the labor force. So for example, the ESI has already been cut by the government, I think a few months ago. So one of the ways to improve the culture, perhaps, culture is not universal, it's not monolithic, is to formalize the labor force faster. And now if we are going for a social security net, which is independent of your workforce, then having it in a kind of, you know, Second World War industrial sense where you need to pay PF and ESI, and therefore your welfare is to some sense linked to your employer. I mean, technically now PF portability is also something the government has worked on, making it digital and so on and so forth. So what if we remove that social safety net independent of your employer, therefore reducing the gap between your CTC and your take-home pay for relatively low-income blue-collar workers can suddenly lead to massive formalization. And I think that leads to you are on a stepping kind of ladder where you become more and more formalized and imbibe certain industrial cultural traits. I'm not saying it'll work, but it's possible side benefit of further doubling down on this route that we are already doing.
Good afternoon. Firstly, I think all the three presentations were quite insightful. My question is on the infrastructure spend. You know, one of the key drivers for us to really reach $5 trillion, we all believe, is infrastructure spend. I'd like to understand from you, this government inherited quite a few challenges in terms of that. How do you believe this government has performed in terms of addressing those challenges? And what are the things that needs to be further done in some of the key sectors to ensure that we are on the right track to achieve the 5 trillion? That's one part of the question. Second is the target that the government has set for itself about investing about 100 lakh crores of funds in the infrastructure over the next 5 years. That's a huge sum. Now, where do you think this money will come from, given that there are some constraints on the domestic front? Also from an overseas, you know, raising funds from the foreign markets, as far as sovereign bonds is concerned, there are certain challenges. So where do you think the government is planning to raise 100 lakh crores for the infrastructure spend?
Okay, sure. On infra, I think absolutely very critical questions. Thank you for the questions. So the government has mentioned about 100 lakh crores, which basically comes down to about $1.4 trillion over the next 5 years. And obviously that's not just government spending, that's government facilitated, including private, PPP, EPC, all kinds of spending. But that's still unprecedented, definitely, by Indian economic history standards. And infrastructure is absolutely critical. So I think my sense of how that will happen is, see, globally interest rates are very low. In fact, negative yielding debt kind of peaked out at $17 trillion, and right now it's about $11 trillion. So the context of that is that there is clearly a demand for some kind of stable, predictable yield if that can be given to global institutional investors. And so you know, the government in the first term did a lot of legal back office work on creating these new instruments like REITs and InvITs. And we're in the very early stages. There's one REIT has been launched in India, it's done very well. Embassy, in a bad market, it went from 300 to like 430 rupees right now. The two InvITs which are listed have not done that well in terms of market price performance right now. But I do see more and more listed and private REITs and InvITs being one channel of getting quasi-equity, quasi-debt, foreign money into India. So you rightly mentioned that if you just raise pure debt bonds in foreign markets, that's problematic both in terms of executing it as well as in terms of macro risks that compounds. But capital which gives a lot of steady dividends is technically equity, even though it feels like debt. So REIT and InvITs kind of then securitizing it into some kind of mutual fund or ETF. For example, the first Bharat bond ETF was just initially launched by the government. So far we had no ETF which could actually allow a retail investor to simply invest into a diversified stream of debt or debt-like cash flows. There also your tax incentives are not as good for compared to equity mutual funds. So I think a lot of, then there is this recycling of capital, TOT, toll operate transfer. So a lot of the golden quadrilateral expressways and highways, I should say not expressways, were bought by Australian and other Canadian pension firms in the first couple of rounds of auctions, and they've done pretty well. So there are basically the legal infrastructure is being laid out for quick recycling of capital. So you build something, either EPC or HAM, you kind of recycle that, or in the case of commercial real estate, you recycle it through an REIT. You get the capital, hopefully at a better kind of rate by lower discount rate, and then you reinvest that. So that is on the funding side. On the execution side, many challenges remain in terms of eminent domain and land acquisition. There are political challenges. Governments change. Amravati happened in Maharashtra. Now there are talks about not changing the name of the expressway, RA metro station, not doing the bullet train. So there are two steps forward, one step backward. So I would say the $1.4 trillion goal is a bit aspirational, but the building blocks of very fast recycling of capital, not through development financial institutions. See, what happened is a lot of our banks, like ICICI, initially were development financial institutions. Then they ended up becoming private retail banks. We don't have a liquid bond market. So how do you fund infrastructure? We don't have the DFIs, we don't have the bond market. So the government has tried to bring these new ways of recycling capital. Whether we actually end up hitting $1.4 trillion or not, I'm not sure, but I do think we'll see very significant acceleration.
So, yeah, one of my favorite, most painful points that Pranab Bardhan made many years ago was in about 1991, India and China were roughly the same level of infrastructural development. And it's very, obviously something that we need quite extensively. I think to the question of have they done, how have they done, I think reasonably, I think it's pretty clear that there's been a push in this direction and trying, as Harsh had suggested, many different ways of doing this. I worry a little bit about foreign financing of anything sovereign in India. I have to say that worries me intensely. As to where funding can come from, I think one of these things that I mentioned in this slide, one of my slides, is people underestimate how important this differential between the interest rate on government debt and the growth rate is. If you have a 1%, I believe I did this calculation some time ago, a 1% increase in that spread, that growth of the economy is higher than it gives you about 0.7% of GDP space, a primary deficit, not, so that's a huge amount, right? So to the extent that interest rates come down, specifically for government debt, there's enormous amount of space that may be available. By the way, it comes down to stabilize at the rate that the encasing committee report wants you to do, right? So I think it's very important that that is a place where you can actually see that.
So we'll take one more question and then.
Yes.
Yeah, we can hear you.
My thoughts, these are more of a thoughts than the question. What we have seen, or rather, I'm absolutely of the opinion that this 5 trillion economy by 2024 is more of a politically motivated statement than wherever anything which you can achieve by 2024. And I have reason to believe that, and the reason to believe are into many of the anecdotal thoughts I have. Government keeps announcing many things like this infrastructure funding, 100 smart cities, digital India, make in India. I think somewhere they need to publish the quarterly scorecard to see what has been announced and where they reached up to, right? It's very important for the people like us to understand all these announcements have been made for a particular reason, or there is a significant political will to achieve. What I want to further comment on this is that, look, the respectable finance minister, now that we have a topic about pre-budget dialogue, right? Those who have read the last budget announced by her, I think it was quite insipid. There was hardly any substance into that, except charging a significant tax on the high net worth individual. And it is something which gave a feeling that a person without much of the depth of understanding the economy and finance is somebody who's trying to do by trial and error method, right?
Sir, can you please mention a specific question, sir? Specific question.
Yes, the specific question is about the tax which has been put into is the one which has been putting the economy confidence pretty low, and that is what been talked about in many corporate circle. And we can do many analysis and paralysis, but however, I think, do we have a competent person to lead as a finance minister of the country? Because the leader, the action is from the leader.
So we got the
No,
question.
I mean, first
I'll first answer. I'm not sure. I think it's above my pay grade to rate finance minister in 6 months. I agree with you. The budget, in terms of what she presented, in terms of raising the rates, was counterproductive. Absolutely, fully agreed with you. On the direct taxes more broadly, Dr. Virmani had spoken in the morning. What is known as a Laffer curve effect. My colleague here, Karan, has done a lot of empirical research on that. What that briefly means is the top marginal rates in India are certainly very high, that ignoring all kind of moral and normative arguments, they actually lead to lower compliance and therefore a lower tax to GDP collection rates. Effectively what is happening is, again, I think Dr. Virmani said it indirectly, is that for all salaried employees who are in the high tax bracket, it gets cut at source, but a lot of small businessmen may or may not fully comply, and along with all the sticks that we've done for formalization, where are the carrots? So in that sense, I fully agree with you. Hopefully we'll see some of the DTC action recommendations being implemented in the coming budget. It is, I agree with you, unfortunate that the DTC committee report has not been published or for public discussion and debate. So I'll leave it at that. And
my question is to Professor Arjun.
No, I think
that's fine.
Yeah.
I mean,
Okay.
that's fine.
So I just wanted to respond on a quick comment. I think we as a sort of self judge at times too soon people when they're in high positions, and this is quite problematic, because if you look back when she was sworn in, she barely had 2 weeks to present a budget, which meant that the budget effectively was already being prepared. So if you want to judge her performance as a minister, I think you look at what she's done from August onwards, August onwards or this budget. So she effectively redid the entire budget. She announced the biggest ever corporate tax cut in Indian history. More importantly, it was the third biggest tax cut ever anywhere in the world. So, yes, there were certain mistakes that were made, but the fact is that she learned from the mistakes and she's, trying to avoid them now, or she's correcting them. So I think it's extremely unfair to say that she's not a competent FM, especially because she's given us a lot of reasons to believe that she's a quick learner and she's realized what needs to be done in just a period of 6 months.
I want to just quickly comment on the, I'll come to the question, sorry. Just quickly comment on the $5 trillion, which is what you began with. As you may have noticed, I actually didn't say it's possible or not possible. I just said it's too far away for us to actually see. I think our underlying potential in this economy is there, right? I mean, the question is unleashing it, and we don't know whether we can unleash it with the current, I think, very significant roadblocks, and I think that's where the concern is.
My question is to Professor Arjun. Yeah. For a moment, you think that you are the finance minister. Please explain to us what measures you will take and how you will revive this economy.
Go into all of them. I want to suggest one thing, which I think I may have slight disagreement with panelists and other people. I believe at the moment the need is for actual government expenditure, and not necessarily tax cuts. And this is not to say whether tax cut is good or bad, but the primary problem right now is a demand problem. I think that is quite well recognized, and to the extent that you can find simple ways of making sure that that demand, example, paying your bill on time, use the education cess, as I said. Similarly, devolve expenditure quickly. Yeah. Make sure that there are particular areas. Have medium-term plans which you can actually see, following up your report card question, that you can actually see progress to. There's too many things to talk about, and we have very little time, but that's my general sense, that we should start moving away from thinking that right now, at least for the next 2-3 years, that the private sector is going to be the engine. At least for some time, we should have a projection that it will be some public spending.
So I think a key takeaway from here is that what we need is a very sort of strong monetary policy push, which has to be sort of complemented with a fiscal expansion. And I think all of us agree that...
A couple of points I have to add on that very quickly. I think something specific or inflation targeting is deposit rates have not come down. Mm-hmm. Small savings rates have not come down. Fixed deposit rates have not come down that much. And there is this kind of holy cow in our public imagination of seniors' deposit rates. Yes. And so when we speak of what has happened is inflation has come down from 10% to 3%. Right now it's 5.5%, but core inflation is 3.3%. And if we don't get the deposit rates down, we can't get lending rates down. Banks have got to spread a profit. If you can't get lending rates down, you can't get the real estate economy back, you can't get the manufacturing economy back. So at some level, the educated upper middle classes, urban middle classes also have to understand and discuss this amongst ourselves, that why is there so much pushback when there is a very rational cut of small savings and deposit rates being cut, which are actually higher than they were 10 years ago, significantly higher in inflation adjusted terms. So we fix too much on the nominal part, and I think at some level that selfishness comes across. So I agree, along with the tax cuts, we also need maybe more PM Kisan, maybe broaden it to the urban poor, so on and so forth. One final point I'll say is, maybe if the governments can get together, central and state, and reduce the stamp duty, that can dramatically change the real estate liquidity, where there is still a lot of black money, where there is still a lot of problems of demand-supply mismatch. I'll leave there.
Yeah. So I think broadly, I think all the panelists do agree with exactly what is required from the upcoming budget, and it's one of those rare occasions where you find a couple of economists agreeing on similar set of ideas. But I think that's the sort of quality of discussion, right? Because it's clearly driven by empirics, and somewhere there is this sense of optimism, especially ever since the corporate tax cut happened, that there's a change in the way government thinks, even in terms of its revenue calculations, because it is looking for improved revenue through compliance rather than increased rates. So I think there's a significant amount of churn that has happened over the last couple of months, which has sort of added to the structural reforms that we experienced during the last 5 years. And of course, the output gap is extremely negative, and we have a banking sector crisis that needs to be dealt with. So of course, as long as there is stress in the banking sector, we cannot expect 8% growth rate to be realistic, which is precisely why some amount of focus in the budget should also be on empowering a TARP-like program, or getting ARCs to sort of ensure that this sort of mess is taken out of the system as quickly as possible. I think with that we'll probably conclude this panel, and it's been lovely to sort of have you on board, and to sort of have such a nice audience with interesting set of questions.